Welcome back to the Deep Dive. Today we're diving deep into Toro's Q4 2024 earnings call.
Buckle up, there's a lot to cover.
Oh, there is, from construction to golf courses, even your own backyard.
Toro really does have their hands in a lot of different pots, don't they? We'll be looking at everything from those red lawnmowers to the heavy-duty construction equipment they make.
That's right, and we'll break it all down for you, hitting the highlights like revenue, earnings, and the backlog.
We'll also be analyzing how Toro is navigating those tricky economic conditions, the supply chain issues everyone's dealing with, and even how the weather has impacted their business.
Oh, and stick around for our This Is Not Financial Advice segment later on.
We have a trade idea that is, well, let's just say it's pretty out there.
It could be brilliant, it could be completely bonkers. Either way, it'll be fun to talk about.
Before we get to that, though, let's start with those headline numbers from Toro's earnings.
Sounds good to me.
Okay, so their Q4 net sales came in at $1.08 billion.
Up or down?
That's an increase of 9.4% year over year.
Not bad at all.
Their adjusted diluted EPS also saw a big jump, up 34% to 75, which was right in line with analyst expectations.
So they beat on revenue, met on earnings, but the stock still dipped after the release.
Yep, the market can be a fickle beast sometimes.
That it can.
But taking a step back, Toro actually hit $4.58 billion in full-year sales.
Now we're talking.
That marks 15 consecutive years of top-line growth for them, which is pretty impressive in this day and age.
It really is. That's a testament to their consistency, especially in the face of all the economic challenges everyone's facing.
Couldn't agree more.
I did notice, though, that their full-year adjusted EPS dipped a bit to $4.17.
You have sharp eye.
Well, I tried.
But even with the revenue growth, that EPS dip makes you wonder what's going on under the hood, right?
Exactly. What caused that, even with the revenue going up?
That's a great question, and to get to the bottom of it, we need to break things down by segment.
All right, let's do it.
Let's start with their professional segment, which actually saw a surge in sales in Q4, up 10.3%.
Wow, that's a big jump. What drove that?
Primarily demand for their golf and grounds equipment, and also a lot of strength in their underground construction machinery.
So Toro's helping to build our leisure activities and our infrastructure, huh?
They sure are. From golf courses to underground tunnels, they've got it covered.
That's pretty cool when you think about it.
It is.
But you said that was just for Q4, right?
That's right.
What about the full year for the professional segment?
Well, that's where things get a little interesting.
Oh, how so?
For the full year, the professional segment sales actually dipped 3.2%.
Really? That's a surprise after hearing about that strong Q4.
It is a bit unexpected.
So what happened? Why the drop?
A few things contributed to that.
Like what?
They had lower shipments of their compact utility loaders, which are those workhorse machines you see on construction sites all the time.
Ah, so less construction activity overall.
That seems to be part of it.
Anything else?
Yeah, this one might surprise you. They actually sold fewer snow and ice management products.
Wait, less snow removal equipment. Is that because of climate change?
It's certainly a possibility and something worth keeping an eye on as we go forward.
Okay, interesting.
Now let's shift gears and talk about their residential segment.
The home of those iconic red lawnmowers. Curious to hear how they did.
Yeah, that's the one most people are familiar with.
So did people keep buying lawnmowers?
They did. Q4 sales for the residential segment were up 4.5%.
All right, not a bad increase at all.
Yeah, not too shabby.
What drove that growth?
They saw strong sales of their lawn care products through those big mass retailers, which makes sense.
People need to keep their lawns looking good no matter what the economy's doing.
Exactly.
But you said 4.5% growth, so something must have offset some of those gains, right?
You're right. They were actually hurt by those weaker snow product sales again.
So that snow slump is hitting both segments.
It seems that way.
Okay.
Now, for the full year in residential, they actually saw a huge jump in sales, up a whopping 16.9%.
Wow. People really are prioritizing their lawns, even with all the economic uncertainty.
You got it. A well-maintained lawn is a source of pride for many homeowners.
That's a good sign, right? Strong sales, people taking care of their homes.
It is. But there's a catch.
Uh-oh, I don't like the sound of that.
Their profitability in the residential segment took a hit.
Now, this is where things get interesting.
It is, because it shows that just having strong sales doesn't always translate to strong profits.
So what happened? What squeezed their margins in that segment?
Well, a few things, actually.
Tell me more.
Higher material costs played a role, same as it did for a lot of companies this year.
Inflation rearing its ugly head.
Yep. And they also got hit with higher shipping costs. Again, something we've seen across the board.
So it's not just about selling more, it's about managing those costs too.
Exactly.
Anything else impacting their margins?
There was also a shift in consumer buying towards those entry-level zero-turn mowers.
What does that mean exactly?
Basically, people were opting for the more affordable models, which tend to have lower profit margins for Toro.
So even with booming sales, the types of products they're selling can make a big difference.
You got it. It's not just about how much you sell, but what you sell.
This is fascinating stuff. I'm learning so much.
I'm glad to hear it. But let's move beyond just the revenue and earnings for a moment.
Okay, I'm all ears. What other interesting tidbits did we glean from this earnings call?
Well, one thing that stood out to me was Toro's backlog.
Their backlog. What's so interesting about that?
Well, it ended the year at a pretty hefty $1.2 billion.
$1.2 billion. That's a lot of pent-up demand.
It is, though it's down from $2 billion a year ago.
Still, way higher than usual, right?
Right. It signals that they're still dealing with some supply chain issues and strong demand.
So what's causing this backlog bonanza? What are people clamoring to get their hands on?
Primarily their underground construction equipment and their golf and grounds equipment.
Makes sense, given the strong sales we talked about earlier.
Exactly. It seems like everyone wants those specialized machines, but Toro's having trouble keeping up with the demand.
So how long until this backlog clears out? Any idea?
They estimate it'll normalize by the end of fiscal 2025.
Okay, so about 2 years.
Yeah, give or take.
That brings us to another topic that's been coming up a lot in these earnings calls. Inventory?
Ah, yes. The inventory roller coaster.
It's been a wild ride for a lot of companies, hasn't it?
It has, and Toro is no exception.
So tell me, what's going on with their inventory?
Well, it's an interesting situation.
Okay, I'm intrigued.
They actually have higher than desired field inventories for their lawn care and snow products.
So too much of some stuff.
Yeah, you could say that.
And on the flip side,
On the flip side, their underground construction equipment inventories are actually much lower than they'd like.
so not enough of the stuff that's in high demand.
It's a bit of an imbalance, to say the least.
So what's the plan? How they fix this?
They're hoping both situations will normalize throughout fiscal 2025.
Fingers crossed.
Yeah, let's hope so.
Okay, so we've talked about the good stuff, the sales growth, the backlog, but now let's get real.
What do you mean?
What are some of the challenges Toro's facing in this crazy market?
Ah, the headwinds.
Exactly.
Yeah.
What's keeping them up at night?
Well, like many companies, economic uncertainty is a major concern.
You think?
It's tough to predict what's going to happen with interest rates and how that will impact consumer spending, especially on those big ticket items like lawn care and snow removal equipment.
Yeah, that makes sense. People might be more hesitant to shell out big bucks if they're worried about the economy.
Exactly. And then, of course, there's the weather.
Ah, yes, Mother Nature, always throwing a wrench in the works.
Isn't she, though?
So how's the weather impacting Toro?
2 consecutive seasons of below-average snowfall have really hurt their snow and ice management sales.
So basically, their business is literally feeling the effects of climate change.
It certainly seems that way.
Wow, that's a sobering thought.
It is, but there's one challenge that Toro's actually viewing as an opportunity: the labor shortage.
Now that's an interesting way to look at it. How are they spinning that into a positive?
Well, they're investing heavily in automation, which could be a game changer in a labor-constrained market.
Robots to the rescue.
You got it! They're rolling out a new line of autonomous products, including those robotic lawnmowers we talked about earlier, for residential, commercial, and even golf course applications.
That's pretty cool.
It is.
Robots don't take sick days or need coffee breaks, right?
Nope, they just keep on working.
So this could be a big efficiency boost for Toro's customers and a way for Toro to differentiate itself from the competition.
Exactly. It's a win-win.
So let's recap. We've got the backlog, the inventory situation, economic and weather uncertainties, and the labor shortage, all swirling around.
Sounds about right.
With all that in mind, how is Toro feeling about the future?
Cautiously optimistic, I'd say.
Cautiously optimistic.
Yeah, they're not sugarcoating things, but they're not doom and gloom either.
Okay, what does that translate to in terms of guidance?
Well, for fiscal 2025, they're projecting total company net sales growth of 0% to 1%, which makes sense considering all those headwinds we just talked about.
So basically flat revenue.
Pretty much.
What about the different segments?
They're expecting the professional segment sales to grow in the low single digits, while residential is projected to decline in the high single digits.
Okay, so some growth in one area, some decline in another, all balances out in the end.
Exactly.
Makes sense, especially given what we know about the inventory and demand normalization they're expecting.
You got it.
What about earnings?
They're anticipating adjusted EPS in the range of $4.25 to $4.40.
So potential for some earnings growth even with the flat revenue.
Yeah, it's the hope.
How do they plan to achieve that?
They're also anticipating improvements in both their adjusted gross margin and their adjusted operating earnings.
So a focus on efficiency and profitability.
Exactly. They're aiming to squeeze more profit out of each dollar of sales.
Smart move in this environment.
Absolutely.
Okay, so short term, they're being cautious. But long term, how are they feeling?
Looking further out, Toro's banking on a few key growth drivers to keep things moving in the right direction. Well, continued robust demand for underground construction equipment is one.
Infrastructure spending, always a good bet.
Then there are those positive fundamentals in the golf market, which we touched on earlier.
People are still hitting the links, even with the economy being shaky.
And let's not forget their dominance in the zero-turn mower market.
Those things are like the Cadillacs of lawnmowers.
You could say that.
So a mix of macro trends, market leadership, and those innovative products they're developing, it sounds like a solid long-term plan.
It does. Plus, they're leveraging technology investments across their whole portfolio.
Like those autonomous mowers.
Exactly. And let's not forget their track record of disciplined execution and strong financial performance.
15 years of top-line growth doesn't happen by accident.
Nope. It takes a lot of hard work and smart decision-making.
All right, that's enough of the serious stuff for now. It's time for the segment everyone's been waiting for.
Oh, you mean this is not financial advice segment?
The one and only.
Yeah.
Get ready, because this one's a doozy.
Buckle up, folks. This is going to be a wild ride. All right, before we get carried away, just remember, this is all purely hypothetical and most definitely not financial advice.
Of course, of course. Always good to remind everyone.
But let's have some fun. Given what we've learned about Toro today, what if? And hear me out. We went long on golf courses and short on snow removal companies.
Whoa, hold on a sec. That's pretty out there.
It is, isn't it?
I kind of like it, though. I like where your head's at with this.
So essentially what we'd be doing is betting on warmer winters and a booming golf industry.
Exactly. We're talking about aligning ourselves with those macro trends Toro was highlighting, right? More golfers, less snow to shovel.
You got it.
But let's break it down a bit further. What's the bull case for golf courses?
Okay, so golf's been gaining in popularity, especially among younger people.
That's right. I've heard that too.
It's seen as a social activity, a way to get outside, get some exercise, enjoy some fresh air.
Right.
Plus, if this whole climate change thing really does lead to milder winters, well, that just extends the golfing season in a lot of places.
That makes a lot of sense. And on the flip side, what's the bear case for snow removal companies then?
Well, think about it. If we see consistently less snow, demand for their services is naturally going to decline.
Oh yeah, no snow, no need for snow removal.
Exactly. And that could lead to all sorts of not so good things for them. Lower revenue, their margins get squeezed, the whole 9 yards.
So we're shorting those companies that are basically dependent on those snowy winters.
Precisely.
Okay, I see the logic here. I really do. But there's got to be a catch, right? This whole idea is based on the assumption that these climate trends are going to continue. But what if next year we get slammed with a couple of huge snowstorms?
You bring up a great point. It's always a possibility, always a risk to factor in, right? It's hard enough to predict the weather next week, let alone try to forecast it long term.
Exactly. It's a gamble.
But hey, that's what makes this this is not financial advice trade idea. We're just speculating on potential futures here, playing with ideas.
I love it. It's a really interesting way to connect those big macro trends with possible investment opportunities.
Right. And again, this isn't about giving specific advice or anything, just sparking those what if questions and getting people thinking.
Absolutely. And like you said, anyone seriously considering this, or any trade idea for that matter, needs to do their own research, weigh the risks, all that good stuff.
Couldn't agree more. This segment is all in good fun, just for entertainment and exploring hypothetical scenarios.
Speaking of exploring, there's one key aspect of Toro we haven't really touched on yet. Their actual financials.
Oh yeah, let's dig into those numbers, see what story they tell us.
What stood out to you from their reports?
Well, their gross margins, both reported and adjusted, came in at 32.4% and 32.3% for the quarter, which is down from last year.
So classic margin pressure, huh? Seems like we've been hearing that a lot this earnings season.
Yeah, it's a common theme.
What's the culprit this time?
The usual suspects, really. Higher material costs, higher freight costs, and even higher manufacturing costs all played a role.
So those inflationary pressures are hitting them too, huh?
Yep, they're not immune.
But they did manage to offset some of those increases, right?
They did. They've been really pushing their AMP initiatives, which stands for Amplifying Maximum Productivity. So all about finding ways to squeeze more profit out of each dollar of sales.
Smart move, especially in this environment.
Totally. And it seems to be working, at least to some degree.
What makes you say that?
Well, their SG&A expense as a percentage of net sales actually decreased for the quarter, which suggests they're getting better at controlling costs.
That's a positive sign.
It is, and if we look at their operating earnings as a percentage of net sales, we see a slight improvement for the quarter, up to 10.1% from 9.6% last year.
So even with those headwinds, they're managing to improve their efficiency.
Exactly.
But is that translating to the bottom line? That's what investors really care about.
Well, their full-year free cash flow was significantly higher year over year, coming in at a healthy $471 million, which reflects a conversion ratio of 112% of reported net earnings.
Now, those are the kind of numbers I like to see. Shows they're generating cash and using it effectively.
And they're not just sitting on it either.
What do you mean?
They actually paid down some debt and even increased their dividend this year, which are pretty good signs that they're confident in their future cash flows.
Makes sense.
You know, there were some concerns floating around before the call about their inventory financing.
Oh, yeah, I remember hearing about that.
People were whispering about their Red Iron joint venture, you know, the one that provides financing to their dealers.
Right. There was some chatter about its stability.
Yeah, some investors were getting nervous.
So did Toro address those concerns on the call?
They did. They emphasized that Red Iron operates just like any other floor plan financing program, nothing unusual there.
So basically reassuring everyone that their dealers are financially sound.
Exactly. They also pointed out that repurchases of inventory from dealers were immaterial, which is a good sign.
Indicates their channel partners are in good shape and able to manage their inventory level.
Exactly. So hopefully that puts some of those worries to rest.
Fingers crossed.
Remember, though, this is just one earnings call, one snapshot in time. The market ultimately decides whether Toro's story holds up in the long run.
That's the nature of the beast.
It is, but at least today we've gained a deeper understanding of what's driving their business, both the good and the bad.
Definitely. It's like putting together a puzzle, piece by piece.
Exactly. Who knows? Maybe we'll all be driving around in those robotic lawnmowers sooner than we think.
I wouldn't mind that. Less yard work for me.
Just got to make sure they don't become self-aware and take over the world, right? Skynet and all that.
Now that would be a trade idea for the ages. Shorting humanity, going long on robots.
I don't know about that, but it's definitely something to think about.
All right, let's stick to analyzing earnings calls for now. Maybe save the robot apocalypse for another day.
Agreed.
But hey, that's what makes following these companies so interesting, right? There's always something new to discover, some new trend to analyze, some crazy new trade idea to brainstorm.
Never a dull moment in the world of finance.
That's for sure.
Well, I think that about wraps up our deep dive into Toro's Q4 earnings.
I think you're right. We've covered a lot of ground today, from their impressive track record of growth to those challenging headwinds they're facing.
We explored their strategic initiatives, their financials, even ventured into that this is not financial advice territory with that wild trade idea.
It was a fun one.
It was.
Hopefully you all enjoyed listening as much as we enjoyed discussing all this.
Yeah, thanks for joining us on this deep dive, everyone.
Hopefully you walked away with a better understanding of what Toro's all about and what they do.
Yeah, we covered a lot.
They're sure.
And remember, this is just the beginning, like a jumping off point.
Right.
It's up to you to dig deeper, do your own research, form your own opinions.
That's the fun part.
It is. Investing is a journey, not a destination. You know what I mean?
You always got to keep learning, that's for sure.
Absolutely. And who knows, maybe you'll come up with your own crazy, this is not financial advice trade idea.
Exactly.
Maybe you'll strike gold or at least have a great conversation starter at your next cocktail party.
That's the goal.
Until next time, happy investing, everyone.
And we'll see you on the next deep dive.